Seasoned Investor Part 14. Hello and welcome to today's video. In this video, we'll see how we can lessen the impact of high inflation rates, how you can manage the threat of inflation in your portfolio, and what you can do to protect your wealth. So like and subscribe this channel right away so that this video reaches a lot of people. See, when inflation hits, the prices increases and that devalues your money's purchasing power. The money loses its purchasing power. Hence, the value of the money that is in your wallet is not worth as much as it was yesterday. See, there is no foolproof method or set rules to, create a wonderful portfolio. But yeah, there are some things which helps you build a sound financial portfolio. We'll discuss 3 things that we can do to avoid or minimize the impact of inflation in your portfolio. Number 1, avoid investing too much in long-term bonds. See, bonds are affected by inflation and rate hikes because they are fixed income instruments. Now see, we understand most bonds give us a coupon rate which does not decrease over time. And that's the reason why people go and buy bonds, because the payments do not decrease over time, even in adverse conditions. But they don't increase either. So what happens is, with a fixed payment comes the risk of currency devaluation. So when the value of the currency decreases, the amount of money that you get out from a bond payment, the value also decreases, right? 100 rupee as a dividend or as an interest payout from a bond this year is not equal to 100 rupee as a dividend payout from that same bond next year, or maybe 5 years later, 10 years later. The value of that 100 rupee is not 100 rupee anymore. So what happens is your effective bond income decreases. Although it does tell you that the bond is paying you a coupon rate of 8%, 9%, 10%, 12% or whatever it is. But the effective money that you get out of that 12% payout is not that much. And to sprinkle salt in your wound, if you buy a long-term bond, 10 years, 12 years, 15 years, you get a healthy, hefty dividend payout of say 10%. You feel lucky. A 10% dividend payout doesn't mean much in year number 6, 7, 8, maybe 9, 10. Doesn't make a sense. The payout from the coupon rate doesn't even beat the inflation at that point of time. So you lose money regardless of how safe you think your investments are. So in our opinion, that's what we believe, that's what I believe, is having a bond in your portfolio, a long-term bond in your portfolio is not a very good investment plan. It is definitely not a very good investment plan. If you really want to have bonds, if you really want to have your money invested in bonds, go for short-term bonds. With this, you can nullify the effect of inflation working against you on your bond investments. The long-term effects of inflation, you can nullify that with the short-term bond purchase. Or if you really want to keep up with the inflation, maybe you might choose to invest in IINSS, which is the Inflation Indexed National Savings Certificate in India, or the TIPS in the United States. Now with these kind of investments, when the inflation goes up, your payout also goes up and vice versa. So you tend to not lose against the major inflation impact on your portfolio. Now there is one good thing about the IINSS, which is in case of a deflation, when it's a negative inflation, you still get at least a minimum of 1.5% guaranteed return from that product. And also there is a 0.75% spread, which is over and above the actual inflation. So actually you never lose out your money in inflation. You always beat the inflation. Point number 2, own investments which has the pricing power. What does this mean? When the cost of things increases around you, some companies have the power to pass on this price to the customers. This is known as the pricing power. And this helps these companies earn and maintain profit even at bad times. Just take for an example, the real estate rental incomes. So with rental incomes, if you're the owner of the property, he decides to increase the rent, increase the rental income as per the inflation, he would just go back and say that he would just increase the rate. And it's seen that most tenants would agree to this justification that, okay, fine, the inflation is high, 7-8% or whatever it is, it's okay to give this payment. Most tenants would not take the hassle to shift and find a new property at lower rate. They have settled down there. Most probably they would not like to shift. They would probably give you the extra a few thousand rupees that you're asking for. The life insurance companies, mediclaims or whatever it is, if there is a price increase, the premiums go up. You have nothing to do. You have already purchased the mediclaim insurance. If you have already purchased the life insurance or whatever it is. If it's not a term plan, these insurance companies, they have the free will to increase their premiums. And you've got no choice. You do not want your policy to lapse. You will buy them. You will pay the extra premium that they're asking for. That's the advantage. That's the pricing power advantage. Now, it's not always necessary that the pricing power acts during the time of inflation. It might also happen that when the demand of a product is less, the sale is less, the companies with pricing power, they still increase the price of a product just to safeguard their company from incurring more losses. So in our opinion, when you do a fundamental analysis of a company, when you analyze the stock, look for this parameter. Does this company have a purchase or a pricing power? Can this company sustain in down market, in down markets? Can this company still run profitable in down markets? Number 3, commodities. Commodities have a store value which is independent of the currency and the purchasing power. Hence, it can act as a good hedge against inflation in your country. Wheat can be eaten, oil can be used as a source of power, gold, silver, other metals can be used in industries, they have their industrial uses. So, commodities will always have a purpose to exist in this world. The requirement will always be there. It will not devalue its value. The value of a commodity will not come down because of inflation, because of your currency. It will always have a value irrespective of your currency. Just like real estate investments, they are not commodities, but they do not have a correlation with your currency. Similar to that, commodities also do not have a correlation with your currency. Now the problem is, you cannot store barrels and barrels of oil in your home, in your godown, or maybe tons and tons of gold. That doesn't happen. There is a law in the country. So what you can do is, you can buy ETFs, you can buy the derivatives. That's how you trade on commodities. So the bottom line is, retool your portfolio to defend it against the purchasing power. Talk to your financial planner to build something specific for your portfolio, something which you can handle. That's all for today. See you again in the next video. Till then, SG signing off. Goodbye.